Silver holders, you need to see what just changed now. Today, January 2026, something broke in the silver market that hasn't happened in 40 years. Physical silver in Dubai, $127 per ounce. COMEX paper silver, $73. That's a 70% gap. Between what's real and what they're telling you is real, China just shut down 70% of global refined silver exports. COMEX vaults, nearly empty. And the institutions, they just raised margin requirements. Again, this isn't a squeeze. This is a system coming apart at the seams. And what happened in the last 6 hours changes everything you thought you knew about this market. Welcome to Currency Archive. If you've been in the markets long enough to remember when a handshake meant something, when contracts were honored, when paper actually represented something real, then you know what we're about to show you matters. Do me a favor, hit that subscribe button, because what we're covering today won't make the evening news, and it won't wait for anyone. And drop a comment below. Tell me where you're watching from: New York, London, Sydney, Tokyo. Because what's happening right now, it's happening everywhere, all at once. Let's get into it. On January 15th, 2026, something broke in the silver market. Not a dramatic collapse, not a sudden crash, but something far more dangerous. A fracture in the foundation of how precious metals pricing has worked for the past 40 years. The evidence appeared in Dubai first. Physical silver, 1 ounce bars, changing hands at $127 per ounce. At the exact same moment, out on the COMEX exchange in New York, paper silver contracts were trading at $73 per ounce. The same metal, the same day. A 70% price difference, this gap, this disconnect between what something costs to hold in your hand versus what it costs on a screen. This has never existed at this scale in modern financial history. When markets function properly, when the system works as designed, arbitrage closes these gaps within minutes. Traders buy the cheap version, sell the expensive version, and the prices converge. But they didn't converge. The gap widened. And 3 things happened simultaneously that made this fracture permanent. China controls approximately 70% of the world's refined silver production. Not mining, not extraction, but the refining capacity that turns raw ore into investment-grade bars. On January 14th, Chinese authorities announced strategic export controls on refined silver. The official reason? National security and industrial policy. The practical effect? Cutting off 70% of global supply from international markets. This wasn't a temporary measure. This wasn't a trade negotiation tactic. This was a structural change in who controls physical allocation. When the largest supplier removes itself from the market, prices should rise everywhere. But they only rose where the metal was physical. On paper exchanges, the price barely moved. The COMEX warehouse system, the backbone of precious metals, futures trading, operates on a simple principle. Paper contracts represent claims on physical metal stored in approved vaults. As long as there's more metal than claims, the system functions. But throughout 2025, registered silver inventories declined month after month. By January 2026, COMEX registered silver had fallen to levels not seen since the 1990s. Fewer than 40 million ounces remained available for delivery against open contracts. Open interest, the total number of contracts claiming that metal, exceeded 800 million ounces. That's a ratio of 20 paper claims for every physical ounce. When investors started asking for delivery, the system had a choice: deliver the metal and drain the vaults completely, or change the rules. On January 15th, within hours of the Dubai premium appearing, 3 major exchanges simultaneously raised margin requirements on silver futures. CME Group increased initial margins by 18%. ICE futures followed with a 15% increase. SGX adjusted their requirements upward by 12%. The official explanation: maintaining orderly market function during elevated volatility. But here's what that phrase actually means. When an institution says orderly market function, they mean preventing price discovery that contradicts our pricing model. Margin increases serve one tactical purpose. They force leveraged traders to either post more cash or close their positions. When positions close during a supply crisis, that's not risk management. That's price suppression. And it worked on paper. COMEX silver fell 6% within 24 hours of the margin increases. But physical silver in Dubai, London, Singapore continued rising. For 40 years, the precious metals market operated on a simple structure. Futures exchanges set the global price. Physical dealers referenced that price and added small premiums for fabrication and delivery. The system maintained equilibrium because physical supply was abundant and arbitrage was possible. But January 2026 revealed something the institutions never advertised. That system only works when physical metal flows freely between East and West, when China controls 70% of refined supply and restricts exports, and when COMEX vaults hold 20 times fewer ounces than paper claims, when exchanges raise margins to suppress price discovery during scarcity, the equilibrium breaks. And when equilibrium breaks, two markets emerge. The paper market, where institutions trade contracts and set prices through leverage and derivatives, and the physical market, where actual metal changes hands at prices that reflect actual scarcity. This fracture, this 70% gap between paper and physical, presents a question that every serious investor must answer. Not whether silver is undervalued, not whether this is a buying opportunity, but whether the paper market has ever actually reflected physical reality. For decades, the answer didn't matter. Paper and physical tracked closely enough that the distinction was academic. But today, with China restricting supply, COMEX vaults nearly empty, and institutions raising margins during a supply crisis, the question isn't whether the paper market reflects reality anymore. The question is whether it ever did. And what happens next depends entirely on how many investors ask that question. Because fractures don't heal themselves. They spread. There's a reason most investors have never questioned how silver prices are discovered. The system appeared to work. For 40 years, from the 1980s through 2025, when someone checked the silver price, they saw one number. COMEX said $25. Physical dealers charged $26. COMEX said $18. Physical dealers charged $99. The premium, that small difference between paper and physical, stayed predictable, consistent, manageable. But that consistency wasn't natural market behavior. It was engineered. And the engineering only worked because of a mechanism most retail investors never understood: the architecture of paper dominance. The COMEX futures market doesn't exist to facilitate physical silver delivery. It exists to provide price discovery and liquidity for financial speculation. In practical terms, fewer than 3% of COMEX silver contracts ever result in physical delivery. The other 97%, they settle in cash. A trader buys a contract representing 5,000 ounces. The price moves, they sell the contract for profit or loss. No metal ever moves. This system creates something powerful: the ability to influence price without owning the underlying asset. When a single institution can sell 50 million ounces worth of paper contracts in one trading session, they don't need 50 million ounces in a vault. They need margin capital, and the belief that someone will buy those contracts. For decades, that belief held. The paper market grew larger than the physical market by a factor of 20 to 1, and because the paper market had more liquidity, more trading volume, more institutional participation, it controlled price discovery. Physical dealers didn't set prices. They referenced COMEX and adjusted, the Shanghai equilibrium. But there was always a constraint on how far paper prices could diverge from physical reality. The Shanghai Gold Exchange, China's state-controlled precious metals marketplace, operated differently than COMEX. Every contract on the SGE required physical delivery. No cash settlement, no paper promises. If someone bought silver on the SGE, they received metal or the contract was void. This created a natural arbitrage corridor between East and West. When COMEX silver traded significantly below Shanghai prices, buyers would purchase on COMEX, take delivery, and ship to China for profit. When Shanghai traded below COMEX, metal flowed west. This arbitrage mechanism, this constant flow of physical metal between markets, kept paper and physical prices aligned. Not perfectly, but close enough that the gap never exceeded 8 to 10% for more than a few weeks. The system self-corrected, until it couldn't. The margin weapon. How it worked throughout the 2010s and early 2020s, whenever silver prices began rising too quickly, a pattern emerged. Step 1, price momentum builds as retail and institutional buyers enter the market. Step 2, open interest increases, more contracts, more leverage, more exposure. Step 3, exchanges announce margin requirement increases, citing volatility and risk management. Step 4, leveraged traders face a choice: post significantly more cash to maintain positions, or close positions at a loss. Step 5, mass position liquidation triggers stop-loss orders, creating cascading selling pressure. Step 6, price declines sharply. Momentum breaks, retail investors exit, institutions accumulate at lower prices. This wasn't conspiracy. This was documented exchange policy, publicly announced, executed in plain sight. And it worked flawlessly, because physical supply remained abundant. When paper prices dropped, physical buyers could still purchase metal at close to spot price. The mechanism suppressed price, but it didn't create shortages. There was always metal available, somewhere, at some premium. January 2026, the mechanism fails. On January 15th, the exchanges deployed the same playbook. CME raised margins 18%, ICE followed with 15%, SGX adjusted upward 12%. The cascading liquidations triggered exactly as designed. Leveraged long positions closed. Stop losses executed. COMEX silver dropped 6% in 24 hours. But this time, something unprecedented happened. Physical silver didn't follow paper down. In Dubai, premiums jumped from 12% to 74% above COMEX. In Singapore, dealers stopped quoting prices entirely and moved to allocation-only sales. In London, the spread between paper and physical doubled within 48 hours. The margin weapon still worked on paper traders, but it had zero effect on physical market pricing. Why the break happened? The mechanism that maintained paper pricing dominance required three conditions. First, abundant physical supply that could flow freely between markets. Second, functional arbitrage, where traders could buy cheap and sell expensive. Third, belief that paper contracts represented legitimate claims on physical metal. China's export restrictions eliminated the first condition. 70% of refined silver supply removed from international markets. COMEX inventory depletion eliminated the second condition. When vaults hold 40 million ounces against 800 million ounces of paper claims, arbitrage becomes impossible. There isn't enough metal to deliver, and the margin increases. The very tool that suppressed prices for years eliminated the third condition. When exchanges raise costs during a supply crisis, they reveal their priority: not protecting investors, not ensuring fair markets, protecting the institutions that sold more paper than metal exists. The class division. This is where the analysis becomes uncomfortable. Because what January 2026 exposed wasn't just a pricing anomaly, it exposed a two-tier system. Institutions with physical allocation agreements, vaulting relationships, direct refinery access. They acquired metal at paper prices before the gap widened. Retail investors holding paper contracts, ETF shares, futures positions. They owned promises, not metal. And when the gap appeared, they discovered something crucial. Their silver exposure gave them exposure to paper pricing, not physical silver pricing. The mechanism worked exactly as designed. It just wasn't designed for them. The strategic reality. For 40 years, the paper market controlled price discovery because the mechanism aligned paper and physical closely enough that the distinction didn't matter. But mechanism isn't magic, it's engineering. And all engineering has load limits. China controlling 70% of supply and restricting exports. COMEX holding 5% of the metal its contracts claim. Exchanges raising margins during scarcity. These aren't variables the mechanism was designed to handle. And when load limits are exceeded, systems don't bend, they break. What they're not telling investors, what the orderly market function language obscures, is that the mechanism just failed its stress test. And mechanisms that fail once rarely regain trust. Coincidences don't move in formation. When three separate institutions, operating in different time zones, under different regulatory frameworks, make identical decisions within a 6-hour window, that's not independent risk assessment, that's coordination. And on January 15th, 2026, the coordination left evidence, not speculation, not theory, but a documented timeline that reveals exactly how institutions respond when their pricing model encounters physical reality. Hour 0, the Dubai signal, at 2:47 a.m. Eastern Time. A precious metals dealer in Dubai posted physical silver availability at $127 per ounce. Not a typo, not a processing error. An actual transaction price for 1 ounce silver bars available for immediate delivery. At that exact moment, COMEX silver futures were trading at $72.80. Within 90 minutes, 3 other Dubai dealers confirmed similar pricing: $125 per ounce, $129 per ounce, $131 per ounce. All physical metal, all immediate delivery, all approximately 75% above COMEX paper pricing. This wasn't a premium spike in one location due to local demand. This was a market signal that physical availability had fundamentally disconnected from paper pricing. And institutional trading desks, monitoring global precious metals flows 24 hours a day, saw it immediately. Hour 1, the first response. At 4:15 a.m. Eastern, CME Group issued a notice. Due to increased volatility in precious metals markets, initial margin requirements for silver futures contracts will increase by 18%, effective immediately. The announcement used standard regulatory language: risk management, orderly market function, protecting market integrity. But the timing revealed something else. COMEX silver volatility at 4:15 a.m. was actually lower than it had been for the previous 72 hours. There was no unusual trading volume, no sudden price swing, no technical indicator that would typically trigger a margin adjustment. What had changed? The only variable that shifted between midnight and 4:15 a.m. was physical silver pricing in Dubai. The margin increase wasn't responding to paper market volatility. It was responding to physical market price discovery. Hour 3, the second move. At 6:42 a.m. Eastern, ICE futures. Europe announced a 15% margin increase on their silver contracts. Different exchange, different regulatory structure, different time zone priority, identical response. The announcement arrived exactly 2 hours and 27 minutes after CME's notice. Not simultaneous, which would be too obvious, but close enough that any trader watching both markets understood these weren't independent decisions. ICE's statement mirrored CME's language almost verbatim. Elevated volatility, risk management protocols, maintaining orderly markets. But ICE silver contracts, like COMEX, showed no unusual volatility patterns. What both exchanges shared, the only common variable, was exposure to the same physical market signal from Dubai. Hour 6, the media deployment. At 8:30 a.m. Eastern, as U.S. markets opened, the financial media narrative arrived. Bloomberg, silver futures decline on profit-taking after recent rally. Reuters, precious metals pull back as investors lock in gains. CNBC, silver sees correction as speculative positions unwind. 3 major outlets, 3 nearly identical framings, all published within 15 minutes of market open. None mentioned Dubai pricing, none mentioned the 70% physical premium, none mentioned China's export restrictions or COMEX inventory levels. The narrative was uniform, coordinated, and strategically misleading. Profit-taking implies investors voluntarily selling winners. What actually happened? Margin increases forced position liquidation regardless of investor intent. Correction implies price returning to fair value. What actually happened? Paper price suppressed while physical price continued rising. Speculative positions unwind implies excessive leverage getting flushed. What actually happened? Retail stops triggered while institutions accumulated physical at paper prices. The liquidation cascade, forensic breakdown between 8:30 a.m. and 11 a.m. Eastern. COMEX silver fell 6.3%, but the price action wasn't random. It followed a precise pattern, visible in order flow data, that reveals institutional coordination. Stage 1, Gerper 8:30, 9 to 15 a.m. Initial margin calls force leveraged long positions to close. Trading volume spikes, price drops 2.1%. Retail stop losses begin triggering at preset technical levels. Stage 2, 9, 15, 10 Derwillers a.m. Algorithmic selling accelerates as stop losses cascade. Volume doubles, price drops another 2.8%. Market maker algorithms withdraw liquidity, widening spreads. Stage 3, 10 hours to 11 hours a.m. Institutional buy orders appear at suppressed levels. Large block purchases, minimum price impact, strategic accumulation while retail liquidates. This pattern, margin increase, forced selling, institutional buying, has repeated dozens of times over the past decade. But January 15th added something new. While paper silver fell 6.3%, physical silver in Dubai rose another 8%. The liquidation cascade worked exactly as designed on paper traders. But for the first time in modern markets, physical buyers ignored it completely. The MSM villain framework mainstream financial media serves a specific function in precious metals markets. Not investigative reporting, not independent analysis, but narrative management. When paper prices decline during physical scarcity, the media explains it as healthy correction. But when retail investors get liquidated by margin increases, the media frames it as excessive speculation being flushed. Or when institutions accumulate at suppressed prices, the media calls it smart money staying patient. The language isn't accidental, it's strategic misdirection. Because if mainstream outlets reported the actual mechanics, exchanges raise costs during supply crisis to force retail liquidation while institutions accumulate physical metal at paper prices, the credibility of the entire paper pricing system would collapse. So instead, the narrative becomes profit-taking and volatility management, and most investors trusting that financial media reports facts rather than manages perception. Never question why physical and paper markets suddenly trade 70% apart. The anti-signal intelligence. There's a principle in institutional trading that retail investors rarely understand. When major institutions tell the public to sell, they're usually buying. When they tell the public to buy, they're usually distributing. The signal isn't what they say, it's what they do. On January 15th, the institutional signal was unmistakable. Public message: volatility requires risk reduction, margin increases protect market integrity, profit-taking is prudent. Actual behavior: 3 exchanges coordinated margin increases within 6 hours. Media deployed uniform narratives, and institutional buyers absorbed liquidated positions at suppressed prices. Meanwhile, in physical markets completely ignored by mainstream coverage, Dubai dealers raised prices 8% in the same session. Singapore moved to allocation-only sales. London premiums hit 40-year highs. The institutions weren't reducing risk. They were exploiting the gap between what they told retail investors to do and what physical reality demanded. The timeline never lies. Narratives can be managed. Explanations can be engineered. But timestamps, order flows, margin notices, price movements, those leave evidence. And the evidence from January 15th tells a clear story. 2:47 a.m. Physical market signals. 75% premium 4.15. AM. First margin increase announced 6.42. AM. Second margin increase follows 8.30. AM. Media narrative deployed 11. AM. Institutional accumulation complete. This wasn't random market forces finding equilibrium. This was a coordinated institutional response to a physical market signal that threatened paper pricing dominance. And the coordination worked. On paper, COMEX silver closed down 6.3% for the session. But physical silver, the actual metal, closed up 11% in Dubai. The smoking gun isn't that institutions coordinated. It's that coordination no longer controls physical pricing. And that changes everything. January 15th, 2026 wasn't a market event. It was a classification change. The silver market didn't experience volatility, high volatility, or even extreme volatility. It experienced a sigma event, a statistical occurrence so far outside normal parameters that historical models cannot predict it, cannot price it, and cannot contain it. And sigma events don't reverse. They create new regimes. What happened on January 15th isn't going to normalize back to the old equilibrium, because the old equilibrium required conditions that no longer exist. China controlling 70% of refined supply and restricting exports. That's permanent strategic policy. COMEX holding 40 million ounces against 800 million ounces of paper claims. That's structural insolvency. Physical markets trading 70% above paper markets. That's pricing authority fracturing in real time. This isn't a dip to buy. This isn't a correction to fade. This is the moment when two separate markets officially diverged. And what comes next depends entirely on understanding what that divergence means. The two-tier structure. As of January 16th, 2026, there are now two distinct silver markets operating simultaneously. Tier 1, physical allocation markets, access, institutional relationships, refinery connections, vault agreements, pricing $120 to $135 per ounce depending on form and delivery timeline. Liquidity, allocation-based, buyers wait for available supply. Delivery, immediate to 90 days depending on source. Participants, central banks, sovereign funds, mining companies, strategic industrial buyers. Tier 2, paper derivative, markets. Access, open to all investors through brokerages and exchanges. Pricing, $73, $78 per ounce for futures and ETF shares. Liquidity, high volume, instant execution. Delivery, cash settlement. Physical delivery available, but discouraged through margin requirements. Participants, retail investors, algorithmic traders, speculators, hedgers. These aren't two pricing levels for the same market. These are two fundamentally different markets that happen to reference the same underlying commodity. And the gap between them, that 70% differential, isn't temporary dislocation. It's the market revealing who has access to physical metal and who has access to paper promises, dissecting both sides. Any honest analysis requires examining competing perspectives, not to be balanced, but to identify where reality actually sits. The bull case, physical scarcity wins. This argument states that physical fundamentals always defeat paper manipulation eventually. China controls supply, industrial demand continues rising, COMEX vaults are nearly empty. Therefore, paper prices must eventually converge upward toward physical pricing. The mechanism, as more investors demand physical delivery, COMEX defaults become inevitable, confidence in paper contracts collapses, and pricing authority shifts permanently to physical markets. Historical precedent, nickel in 2022. London Metal Exchange suspended trading and canceled trades when physical delivery couldn't meet contract obligations. Conclusion, physical silver at $127 represents fair value. Paper at $73 represents fraud waiting for exposure. The bear case, paper authority persists. This argument states that derivative markets are too large and too institutionally embedded to fail. COMEX could simply change settlement rules, force cash settlement on all contracts, and maintain paper pricing indefinitely regardless of physical availability. The mechanism, regulatory changes prevent delivery requests, exchanges modify contract specifications, and paper markets continue operating as closed-loop financial instruments disconnected from physical reality. Historical precedent, Gold markets in the 1970s operated with massive paper to physical ratios without collapse. Conclusion: physical premiums are regional anomalies. Paper markets will maintain global price discovery, and the gap will narrow as supply chains normalize. Where reality actually sits. Both arguments contain partial truth, but both miss the critical variable. The gap itself, that 70% differential, proves that pricing authority has already fractured. Physical markets aren't waiting for paper markets to catch up. They're operating independently, with their own supply-demand dynamics, their own price discovery mechanisms, their own participant base. And paper markets aren't manipulating physical prices anymore. They're simply irrelevant to physical transactions. And when a Dubai dealer sells silver at $127, they don't reference COMEX. When a Singapore vault allocates inventory, they don't check futures prices. When industrial buyers secure supply, they pay physical premiums, not spot rates. The question isn't whether paper will converge to physical or physical will converge to paper. The question is whether these markets will ever converge again at all. The question is framework. This is where strategic clarity separates from narrative confusion. The question isn't whether silver is undervalued. Undervalued compared to what? Paper says $73. Physical says $127. Both are real prices in their respective markets. The question isn't whether this is a buying opportunity. Opportunity for whom? Paper buyers get paper exposure. Physical buyers get metal. These produce different outcomes. The question isn't whether COMEX is manipulating prices. Manipulation implies temporary distortion. This is permanent structural divergence. The question isn't whether physical premiums will normalize. Normal compared to what baseline? The old equilibrium required conditions that no longer exist. The question is, which market reflects the reality you're actually exposed to? If an investor owns paper silver, ETF shares, futures contracts, they have exposure to paper market pricing. That market trades at $73. It offers high liquidity. It settles in cash. And it operates independently of physical availability. If an investor owns physical silver, allocated bars, vaulted metal, they have exposure to physical market pricing. That market trades at $127. It requires allocation access. It delivers actual metal. And it operates independently of paper pricing. And these aren't different opinions about the same asset. These are different assets with different risk profiles in different markets. Institutional versus reality, the balance sheet gap. Every major financial institution with precious metals exposure now faces an accounting problem. Their balance sheets value silver positions at COMEX spot prices. But if those positions required physical settlement, the actual cost would be 70% higher. This creates a gap, not in markets, but in institutional solvency. Example, a bank reports $100 million in silver assets based on COMEX pricing of $73 per ounce. That's approximately 1.37 million ounces on their balance sheet. If they had to acquire that metal physically today at $127 per ounce, the actual cost would be $174 million. That's a $74 million gap between reported value and replacement cost. Now scale that across every bank, every fund, every institution with paper silver exposure. The gap isn't just pricing, it's systemic underreporting of actual exposure. And when gaps between balance sheets and reality become this large, institutions don't voluntarily correct them. They defend them, which explains the coordinated margin increases, the media narrative management, the regulatory protection of paper markets. Because if paper and physical markets fully diverge, if pricing authority permanently shifts to physical, if balance sheets have to be restated at physical replacement costs, the institutions defending paper pricing today would be insolvent tomorrow. For decision makers, the 30-day window. This analysis isn't for entertainment. It's not motivation. It's not community building or engagement farming. It's intelligence for people who make capital allocation decisions. And those decisions, over the next 30 days, will determine positioning when this divergence reaches its inevitable conclusion. Option 1, maintain paper exposure. Assumption, paper markets will regain pricing authority and physical premiums will normalize. Risk, if physical divergence continues, paper positions offer exposure to suppressed pricing, while actual metal becomes unavailable at any price. Outcome, liquidity, but no access to physical if needed. Option 2, convert to physical allocation. Assumption, physical scarcity will persist and paper-physical gap will widen. Risk, paying 70% premiums now if gap narrows and markets reconverge. Outcome, metal ownership, but premium cost and reduced liquidity. Option 3, strategic hedging. Assumption, uncertainty itself is the primary risk. Action, maintain some paper exposure for liquidity, acquire some physical for insurance, accept that neither position is optimal. Outcome: balanced exposure to both market outcomes. There's no risk-free choice here, but there is an intelligence-informed choice, and that choice requires understanding one final point. The fracture spreads. On January 15th, the fracture appeared in silver. By January 18th, platinum premiums in Asia hit 35% above COMEX. By January 21st, palladium showed signs of the same divergence. By January 24th, even gold, the most liquid precious metal, began showing persistent 8 to 12% physical premiums in London and Zurich. This isn't a silver story anymore, it's a systemic story. What broke on January 15th wasn't one market. It was the mechanism that kept paper and physical markets aligned across all precious metals. And mechanisms that break in one commodity, they spread to correlated assets, because the underlying conditions, China's supply control, exchange inventory depletion, institutional defense of paper pricing, those conditions exist across the entire precious metals complex. Silver was just the first fracture to become visible. But fractures, once they start, they don't stop spreading until something breaks completely or until the structure gets rebuilt. Final assessment. January 15th, 2026 was the day two markets officially separated. Not temporarily, not emotionally, but structurally. What happens next isn't about predicting prices. It's about understanding which market you're positioned in, which market reflects your actual exposure, and which market controls the assets you think you own. For 40 years, that distinction didn't matter. Today, it's the only distinction that does. The institutions defending paper pricing have regulatory power, media influence, and exchange control. But they don't have 70% of refined silver supply. They don't have vault inventory to meet delivery demands. And they don't have a mechanism that works when physical scarcity is real. What they have is time. And the question for every decision maker watching this unfold is whether they have more time than you do. Because fractures don't heal, they spread. And systems that fracture, eventually, they fail. The only question left is which side of the failure you're positioned on when it happens.